Okay, good morning, everyone. Actually, it's good afternoon. Today is the 29th of May. It's a Wednesday, and well, I think today I want to talk a little bit about stop losses. Should we use a stop loss? Should we not use a stop loss? The conventional answer would be yes, you should use a stop loss, and I tend to believe that is the best way too. I've also seen some traders who do not use the stop loss, and they use different ways of getting out of a bad trade. And most of this is like based off experience and can be extremely tricky. Some use grid trading, some use martingale, and all that styles are always they always carry quite some risk to it. It's like living life like a pirate. You can make a lot of money, but just need to go wrong once and things can come crashing down and things can go wrong very fast. Okay, so, but I'm not going to say it's good or bad, it's wrong or correct because, if let's say you've got $1 million to invest or $10 million to invest, right? And let's say you're a VC firm, you're going to invest in about 10 projects. 80% of them is going to fail, maybe 20% of them is going to succeed. And whatever you make from the ventures that succeed is going to pay off, for all those losses that we had. So I've also seen, so in other words, when it comes to forex trading, I've seen accounts get blown. For guys who don't use stop loss, the accounts get blown. But let's say I'm just recalling this from memory. Let's say you start off with a small account, say 1,000, and they build it up to about 10,000 in just a couple of months, right? Very aggressive trading, no stop loss. Sometimes the account gets blown. So if they lose, they're going to lose their $1,000 account. But if they believe that strategy is able to make them $10,000. Once they make the 10K, they'll take out 9,000 and then they keep 1,000 and try again. The 1,000 gets blown. That's what they're basically willing to risk for a very high risk trading strategy. Is that right or wrong? Well, I don't know. If it makes money for them, I guess it's okay. But generally, if you're investing for people, people don't like to see their money getting blown that way. Because getting people to lose like $1,000 or $10,000 and not something most people would want. Most people prefer investors who give you 50 or 100K or $500,000, right? They want to see some kind of steady growth without crazy drawdowns, basically. Better slow and steady, get stopped out, it's okay. If you lose 1,000, 2,000, the count I say is about 100K and above. You lose 1K, 2K, 5K, but if you know how to make it back, it's better to cut those losses than to let it grow, right? But we can talk about the dangerous stuff first. And then we'll talk about what I think is a safer way to trade, basically. And safer way meaning they're trading for other people, right? Trading somebody's money. And I think that from a fund management perspective, I think that's better. All right. So let's go. The dangerous style of trading is something that I'm not that familiar with because I don't really do it. Right. But my educated guess on it, right, would be let's say, let me see, let's go to try to recall how these guys trade, right? Okay, let's say we go to daily, right? This is pound dollar. So I'm just doing this off the cuff, right? Right. So some of them do it support and resistance style. So here these are the swings. You can see it's coming down now. Right. So basically when it comes down to around this level, they expect a bounce. They expect a bounce. You expect a bounce. You expect a bounce. You expect a bounce. Now, when you trade this, it's also that when people take a buy up, they also need to know exactly how much you think it can bounce. So if this one can move about, this is daily time frame, you think about 20, 30 pip bounce. If it doesn't bounce here, that means the next bounce is going to be over here. And same for this one. See, there's a drawdown. Then you got to believe that it's gonna. So in the initial trade will be something like this, right? So you just have to believe that this one is going to come up here. And if this one had continued down, then the account's going to be in drawdown. Which, in other words, right, the next area of bounce you expect to be over here, right? So if you had double it up here and didn't bounce, now this is in drawdown, that's in drawdown. And now this one over here, you start to increase the lot size. So price action just needs to come up to around here, and you close everything out for profit, because this is some kind of martingale strategy. You know, they're going to be doubling up. If this is 1 lot, 2 lots, this might be 4 lots, and then this might be 8 lots. You know, so the account needs to be able to withstand this kind of strategy, right? The ideal scenario would be that this one just bounces to take some money, you bounce, take some money, you take some money that way. But this kind of strategy, I find it personally for me, I've played around with it, but I've seen some guys do well in this, but I find it risky because it's very easy to see the account go in drawdown of you know, I've seen drawdown of 700,000 just using this method alone, and that's why I don't recommend it to anybody. Now there's also another style. Well, not to say that my friend is wrong, right? I'm sure he has his reason for doing it, but you know. So let's say some people also use something like pivots. So I'm not gonna, let me just put on some pivots here. Pivots. Let's just use a standard one. All right, let me just remove that. Now pivots with SP is 3. Let's see, too much. Let's see it as 2. Maybe let's try 1. Let's just leave it as that. Okay, so in this case, so let's say if we use some kind of Elliott wave theory, if for whatever reason we think this is an impulse, this is a correction, this is an impulse. Now I'm not saying this is what it's going to be, because this thing can always do this, and then it just drops. So the idea of this being impulse, correction, impulse is just a maybe. It's a big maybe, right? Up or down is both possible at this time, right? So, but what I'm trying to say is, some people also use things like pivots. You see the pivot here? So there's a S1, S2, S3, S4. So sometimes we, let's say you can play one standard lot. So let's say you decide to take a buy here, So you're reaching your position that way. You're prepared for the worst case scenario where it drops all the way to the very bottom. So your account must be able to handle this. So let's say you can play one standard lot. You're going to put, say, one standard, maybe you put 0.2 here, 0.2 here, 0.2 here, 0.2, 0.2. Right? So the whole thing has to one standard lot. So basically, once you break this low, you're gonna have to hold on to the trade, and it's best done on the daily time frame, because once you take the buy here, you're somewhere at the low. So when you're at the low, there's always, price action can't go down forever. So after some time, it's going to have to. When it comes down to this level, everybody wants to buy pound dollar at the low, right? So once it comes down to this level, when it starts to swing up, then all this will become in profit again. Now, do I recommend this? I think it's a possible strategy, but the lot size needs to be extremely small for stuff like that. And imagine seeing the account in drawdown, even though it's not going to be too large of a drawdown, but it's still going to be in drawdown, and you're going to have to live through that, basically. All right, and seeing the account rate for a couple of months is not very fun, right? And having said that, if a trader was really good, why not make this money down and then make this money up? Whether market is going down or up, you should try to follow we should try to follow it as much as we can. So let's say you take the buy up, but then it's wrong. because it went, then you just try to follow it down, try to follow it up. That would be the best style of, that's very high and classy trading, I feel, right? All right, let's look at something else here. Like for example, let's look at the dollar yen. I think this one, some people brought to my attention that they were looking for this for the longest time, right? But if you look at the amount of movement down, there's actually a lot of money to be made. If this one was to come down, there's a lot of money to be made here. Even if this was to go up, there's no sense in not making this money. In other words, we need to be very clear on, even though this is the bigger picture, but this is a weekly time frame. There's a lot of money to be made on the very deep movements that come down as a credit structure. So you cannot miss these moves, because many times people's accounts will get blown. You see, if we are not on the right side, right? So let's say we believe this was going to go up, for whatever reason we think this is going to go up. Then if you're going to put on some pivots, right? Then you're going to see, okay, so let's say S1. Let's say you bought here. You have some lots here. You have some. You say you could play one standard lot. You're going to put like five minis there. So this one went up. Then now you got tagged. So of course you're hoping for that, but it starts to turn. So you might say along here, as this one starts to go up, you might be basically trading the price action. And now you got stopped out over there. See that? So let's say now you want to try again. Now the only place where you put an entry is over here and over here. Because why? You believe in this. And you're using this type of pivots, right, to help time the entries, right? It is one style of trading. And what if this one just drops all the way to here? It drops all the way to here. Well, here's the thing. The only way to survive this is that to me, there are two ways. One, you already decide that if this one loses about 10,000 or whatever amount, the trade will have to be cut. Or you just this lot size, let's say 0.2 is so small compared to the account, maybe it's only 0.5% of your account, that even if you drop all the way down to S4, right, you'll still be able to exit off for profit once this one starts to turn around. And the only way to do that, right, is to have this type of entries have require only very, very small lots, right? Some trades I take are huge, and lot size are huge. It might be 10, it might be 20 lots, or maybe 50 lots. Well, those kind of entries, right, require some kind of fixed stop. So if this one was to go, if it comes back here, we stopped out immediately. So these are going to be the opposite. These are based off buy or sell limits. These are based off buy or sell stops, basically. So in terms of swing trades, right, what I feel is the correct way is, if you're doing a swing trade, this is better. The buy stops and sell stops are better for swing trades. You're looking for reaction trades, buy and sell limits would be an appropriate way to trade. Now, buy and sell stops, like this one over here, where it goes this way, it breaks out like this. This, I feel, it's very versatile, basically. You're not going to pick the top and bottom, but you just capture, the move might be like this. You just capture, this is the bottom, this is the top. You just capture somewhere here only. You not capture this top, you not capture this bottom. You only capture somewhere in the middle, and then that's it. This buy and sell limit, sometimes if you're lucky, if you're capturing like here, maybe suddenly it comes here, then it goes up, it does this, and let's say okay, let me just clear that. Let's say it comes here, right? S2, really at the bottom, you got in, you went up, you did this. So I got in here. Let's say I got in here. Somebody else, person A, Fido Dido over here, he's very happy. He caught the bottom over here. So yay, he caught the bottom over here. So he went up. When this one came back down, this is where I would try to, anywhere here or anywhere here, I'll try to get in. Maybe I'll get out somewhere here at the top. So I only managed to capture just this amount, right? This guy, if he actually got in at the bottom using a buy limit, well, he can capture not only this amount, he can capture this amount as well. So he capture both. But the thing is that easier said than done. That's easier said than done because sometimes you're going to encounter scenarios where it just goes up and then I think it crawls back down again. So in limit orders, you tend to have this problem, you see. And to me, limit orders should be more of a bounce or reaction. That's the best because it's better just take the money because when you see it, because just because you get a bounce up here, it does not always mean the upside as well, right? So what else? So that I shared about stops, buy and sell limits. Okay, here's one more. Now, if let's say you take a buy limit over here, it's always some people actually they also put stop somewhere here around this lows over here. Okay, that's one way to tell yourself that you're wrong because, well, if you do an impulse correction, basically this low should not be broken. So that's one way. That's one way to put a stop as well. Okay. Okay. So off my head, those are a couple of ways people put stops, and also what people do when they don't want to put stops. They'll try to average down. All right. A very small lot size. You know. Let me see what else. What about single entry? Single entries. No, I've seen people do. They think it comes to the low. No. Let's go silver. Probably a good one to be this one. So let's say this one is way over here. Let's just take out the pivot. If you want to leave it on, do it and leave it on. Yeah. Maybe if I leave it on, okay. So as you can see over here, silver. If you think that this was going to be coming down like this, and this should go up, it's possible. But can this come down and break this low? Also possible. See. So if you're looking to buy silver, actually one place you could buy is S1 here. These levels here, they're all good places to buy because it's all at extreme low. It's all at the previous lows. This is a weekly time frame. So people are all looking at when it comes to this low, you see. So these are all the places where these are like discount prices, buying silver at discount prices. So you ask me, well, these are all good places to buy. You can put big lots over there. Your account must be able to handle it. So because let's say somebody wants to make your money and someone was in the early buy, well, just swap out orders. Then people who are in the early buy, they're stopped out, right? So they are taught to think that, I must put the stop loss below this price. Just impulse correction, once it breaks below, then I must be stopped out. I mean, for whatever reason, people are trained to have a stop, but they place stops at incorrect places. So let's say they were in early buys, they were forced to sell here. There's a sell stop over here. So once those retail traders are forced to sell, someone takes the buy. Right? So once it breaks this, I'm very keen to buy because I know people are being stopped out right at this low. So you're going to see some huge spikes, the dojis and hammers and stuff like that. So once it breaks this S1, is when it's a good time to buy because it's a lot of pain. It's a lot of pain right there, And then this one has a chance of shooting up real hard. You'll break that, pull back. You'll just continue to go like this, right? And this actually make a very nice kind of, three-wave structure, like 1, 2, 3, like this. Okay, so these are all good places to buy. Now, if you ask what's the stop loss for this one, I think some people actually took the buy, tried to take this buy up. They should have been stopped out somewhere here. Stop loss. They should be stopped out somewhere over there, or over here, right? So price action is now coming down, and to me, this is a daily chart. It's an all-time. Let's see where it is. See the daily chart. This is where we are over here. So you see, can silver drop to like 12, drop to 10, drop all the way down? Well, it could be. It could be. I mean, no reason why you cannot do that, right? So that's why these limit orders are always there's always this danger. There's always this danger. If we just take let's put it on again. You know, if we just take buying off pivots, right, and all this this structure over there, you know, then these are buys with very little confirmation, right? And if anybody wants to trade this way, they must be prepared to go into drawdowns, and the only thing that will save the account are very, very small lots. Right? If you don't want to trade this way, then of course the other way is to wait for some kind of structure. When it breaks, that's when you buy. Be prepared for this pullback. Then from here, you know, you can add lots and buy again. And then of course your stop should be below the previous structure, because that's what the motive ways are supposed to do. They tend not to break, you know, take out stops unless it's making a big structure of its own, right? So let's think about stop loss. Now, should you play without stop loss and put huge lots? Of course. If it's a single trade, I guess the trader might be able to survive the drawdown. But if he was to put many trades on at the same time, say the person trades silver and then trades pound and then trades $, trades Aussie dollar, the account may not be able to withstand so many trades ongoing at the same time. And if we're in drawdown and we have no stops for like 5 different pairs, it can be quite tricky. You know, I don't think it's a good idea. So if a person who's trading many pairs at the same time, it's a much better idea to allow yourself to be stopped out. Yeah, I can show you one where I actually got stopped out. Let me just show where I got stopped out. Okay, on a very low time frame, say around 10. Yeah. So I do scalp as well. Let me see. Scalping is a good way to trade. Over here, this is 10 minutes. So basically I was looking for, let me see. Yeah, here, this was broken. This came down like so. So I'll just show you where I would be stopped out here. See, it went up there. Now, I would have been interested to enter this at the break of this low. But what I did was, as this was coming down over here, I took an early sell. And my stop happened to be above here, in which I got stopped out. So it came down. So my entry was over here. It should have been over here, but sometimes I just get so confident, and it's overconfident. You know, you think that you're good, and sometimes the market just humbles you again. So that's what happened. So came here, it went up, came down. Thought, okay, now this is the one that's going to go, but it came up. I got stopped out right there. Came up here, but then I see this as structure. So what happened was I made an aggressive sell. My stop now is above there, which is above this. So this basically cannot be broken, right? So now it came back down, and now it's over here. So now, even though I was stopped out here, but because I re-entered here, so now I'm in profit over there, right? And the question is, did I take out the trade? No, because I still expect this price action to actually come down and drop even lower. So this move, so basically this move will allow me to recover my loss from here to here and then some more extra. So this is what I mean by, in this case, I'm basically using structure in order to decide where my stop should be, all right? Let me see, yeah. So that's how I think stop losses should be used, knowing where to place them and knowing, let me see, give some more examples, okay. So I think there was this epic trade that I had called, you know, it's pretty epic, pretty cool, like this one over here. So in this case, price action had the time it had come up here. So we're looking for this. Then it went on to do something like that. So basically, in this case, I was picking the top. All right. So if let's say we had taken the buy here, well, the stop should have been above there. Because why? You don't want to be caught in this suddenly spiking up like so high, right? and then that's your trend line. So you don't. So if you try to pick an aggressive top, then you have to realize you need to be stopped out, especially when the lot size is huge. And you're not, especially when I'm not averaging down. Like 5 minutes, not averaging down like that, but you're just putting a hard like 10 lots over there. Let's say 30 lots over here on gold. That's expensive, right? You better be stopped out, because the count can go bust simply by going up. Even if it came down this way, and the count will go bust before it could come down. So if you're using, let's say we're using a very high leverage, you must be stopped out. Very important. Calculate how much you're willing to lose. You want to be aggressive, take the loss. Just gotta take it. The other way would, of course, wait for a break. Then your stop would be over there. So the stop, it breaks, and then it goes, right? So that's why we do stops now, basically. Okay. So just a brief. I think this was a brief sharing moment. I think about stops. And should you trade without stops? Absolutely not. And if you decide to you decide not to use stop loss, then all I can say is make sure your lot size is smaller than what we will want to normally use. So if you want to use 1 cent a lot, don't use 1 cent a lot, just use 2 minutes, because divide it by 5 or something, right? So that we give ourselves room for error, space to breathe, if you're going to trade without stop loss, right? And that's it. Thank you. And I'll stop the recording